morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off for the week. Welcome to Bloomberg Brief. Let's set your agenda. Mounting pressure, President Biden faces even more calls to step aside as the White House says the former president has caught COVID. Countdown to the ECB, the central bank is expected to keep rates steady as policymakers await for more data. And TSMC boosts its forecast in a show of AI confidence, but the chip sector takes a beating on political risk. We take a breather from that political risk, but it was abundant yesterday. The statistics, again, another potentially historic day. You saw the Philly Semiconductor Index see its worst day since that concern over COVID in March 2020. U.S. stocks to themselves break a 52-day winning streak of not seeing any losses more than 1%. The S&P does fall more than 1% yesterday. A slight rebound this morning. We're up by 1/3%. So that kind of rotationary flavor we'd been getting in this market, that takes a breather. Because yes, everything fell yesterday, but the Russell 2000 didn't fall by as much. This morning, it is declining, down by 0.2%. The bond market, for its part, has been rather tricky. It's this push and pull between the economics and that of the politics of higher deficits, and that means that you don't want to buy duration. Yesterday, we were buying duration. The 20-year auction goes off without a hitch. That helps to kind of quell some of the movement, the pressure upwards in yields. Not to mention that both Waller and Williams came out yesterday, not explicitly saying it, but their language suggested that by September, they're going to have the confidence to cut. This morning, it is pressure. It is yields higher by about, let's call it 3 basis points for spot. 18% is where we stand. That's the picture in the U.S., but we are just hours away from the ECB decision. They are largely expected to hold rates. Traders, for their part, they are closely watching from clues from President Lagarde on the prospects for September meeting, again, because we mostly assume that they're not going to move this meeting. Let's bring in Bloomberg's Lizzie Burden, who's in Frankfurt at the ECB headquarters. So, Lizzie, why is that? Why do markets assume, and most economists, that it's a September cut that's more likely than a July cut today?
Yeah, Danny, not a single economist that Bloomberg surveyed saw a rate cut today. And it's because by that September meeting, they'll have 2 more CPI prints and more data on wages and productivity. They'll also have the quarterly forecast, and they'll have, hopefully, a bit more clarity on what the Fed wants to do in terms of rate cuts and how the French politics is going to shake out. I'm sure there'll be a question on that for Christine Lagarde in the press conference. It's her homeland after all. But it means that today is less about the decision itself and more about the communication around September. I'm sure she has learned her lesson from that June cut, the dangers of over-telegraphing what comes next. So I imagine that she's going to stick to the spiel from Sintra, where they had that ECB forum, and emphasise this data dependence, try not to knock market expectations of 1 or 2 more cuts this year. And the question, therefore, is left, do they reintroduce the easing bias? But that one for the guidance and the press conference later.
Well, all you had to do was listen to Isabel Schnabel to see this coming. Before the cut in June, she had clearly said, it's probably going to be a one and done. How is the Governing Council shaking out at this moment? Is there a clear divide?
Yeah, always listen to Isabel Schnabel. It'll be interesting because you've got the Hawks kind of warning about services inflation at 4%, annual wage growth around 5%, unemployment towards a record low. So they're saying, what's the need to hurry to cut rates at this point? But then the Doves on the committee warning that the recovery in growth is already losing steam. You've got profit margins shrinking because companies are absorbing those higher labour costs instead of passing on the burden to consumers. But what I think is really telling, Danny, is you've even got the Belgian central bank chief, Pierre Wunsch, who's usually towards the hawkish end, even him agreeing that the expectation in markets of 1 or 2 more cuts this year actually looks reasonable. And even if not everybody is singing from that hymn sheet yet, it is becoming a more popular opinion.
Lizzie, we appreciate it. Lizzie Burden in Frankfurt, who will be sticking around through the programs for that ECB decision in a couple hours' time. Joining us now is Ludovic Subran, Chief Economist at Allianz. Ludo, really great to see you this morning. It's definitely been too long. Okay, so you basically write this idea that, okay, they cut last time around, but it was awkward because they had higher inflation and wage data just before the cut. Oh, and not to mention, they all basically increased their forecast for inflation. But there's a difference between it essentially being awkward and a mistake versus a policy error. So let's talk about that last decision. Where does it land on that scale?
The jury's still out on this one, because I think the last meeting, maybe the ECB got a bit ahead of itself. That's for sure, because the latest inflation print was reassuring, but the wage growth re-accelerated to 4.2% year on year in June. So there is this idea that may not go for the same mistake twice. I have a hard time calling it a mistake now that the Fed will finally cut. Because remember, that was the whole idea, that can the ECB continue to cut and go ahead, push through a loosening cycle without the Fed doing it, with the cost that it may entail on capital flight from Europe to the US, right? Now we have a bit more certainty that the Fed will start a rate loosening cycle. So the ECB can cut as they did, then pause, then cut again in September. The real question now is, will they cut again in December if the Fed manages to push through 2 cuts? And of course, the terminal rate is the big question that everybody has, especially as President Trump could be more inflationary and holding back a bit the Fed, while the ECB is really a bit in a true scenario when it comes to growth, right? But it's been quite a politically intense few weeks, right? You yes. wouldn't want, if you were President Lagarde, to be accused of cutting to help the French, for example.
Higher inflation in the U.S., a new Trump presidency means that the ECB can't cut as much. I just wonder what the impact is of this stop-start approach from the ECB. If their aim is to prevent a hard landing, secure a soft landing, but still ensure economic growth in Europe, how far does that stop-start approach actually go?
I think, to be fair, for the ECB to be less contractionary for Europe, they would need to deliver at least 4 rate cuts in 25. So that's quite a normal loosening cycle, right? So that's very important to know whether they want to do that, knowing that services inflation is so sticky, right? And remember, it's very political a moment because of the fiscal consolidation needs. So you started to have, Minister of Finance Lindner in Germany saying ECB shouldn't get into politically strong disincentives when it comes to cutting too much and not providing market discipline to some of the countries that need to adjust almost 1 percentage point of GDP per year to be, committing to some of their fiscal orthodoxy, right? So the ECB has to cut, but if they cut too fast because of the stickiness of services inflation, it will be seen as they give a bit more room for fiscal. I'm more in favor of giving a bit more room to fiscal given the current situation, but that's true that it will be a bit of a catch-22 all through 25, to be honest.
Ludo, you point out, which I think is interesting, and again is something for our American audience to wrap their head around, in this country with a savings rate of 3.9%, is that the savings rate in Europe is 15%, even though wage growth continues. What does that mean, again, not just for the landing, but for the takeoff, for the possibility of robust growth in Europe?
Look, the second half of the year should be a moment of real income growth because inflation is growing less fast than wages. So we should have a bit of a pickup. I think growth really bottomed out in H1 and we should have a pickup in H2. The problem is we have 0.7 growth expectations for 2025, while the US has 3 times as much. So the problem is really this growth discrepancy between the US and Europe, which is very strong. And of course, that means that even if we take off, that would be maybe 1 percentage point growth. And so that won't provide enough confidence to unleash the savings rate. We have record savings rate in Germany, 19%, France, 17%. And we don't see the forward visibility for people to spend that because of precautionary savings for pension reform, because of negative wealth effect from the housing market correction. And so that's the big issue if I were Minister of Finance right now, is to make sure people spend, maybe like Americans have spent over the past 2 years, and that created almost 3% growth.
Fair enough. Ludo, before we go, I want to talk about the Fed, because we had both Waller and Williams speaking yesterday, 2 very influential Fed members, basically saying that September looks likely. They didn't say that explicitly, but they more so did. The market has already priced in a September cut. What difference does it make to you to have these types of Fed policy speakers leaning more dovish, getting more confidence?
Well, it definitely gives me the idea that we will not have a contractionary monetary policy. So it's very important for me that the Fed starts cutting, because the worst thing that could happen now is that the US is in over-tightening mode and we have a recession coming from the US. So this boom-bust scenario. So the fact that the Fed is not a laggard and they actually want to cut, that's reassuring about the end of the overheating in the US, but more importantly about the global financial cycle. Because as you know, everybody is dependent on what the Fed's policy is. Emerging markets, think about those emerging markets that are starting to cut. Had the Fed not started to, anchor this idea of cutting, I would be worried for Brazil. I would be worried for Mexico. I would be worried for some of these economies that have, they need to start cutting to get a bit of a breather for growth. And so the Fed cycle is very important for these economies right now.
Yeah, it's interesting that it's maybe not a verbal cut for the U.S., but a verbal green light for all those other countries you talked about. Ludo, thank you so much for joining us. Enjoy Germany. Ludovic Subran of Allianz. Okay, let's get to some of the other top stories that are trending on the terminal this morning. First up, TSMC raises its full-year revenue forecast, showing confidence in the AI boom after a day of declines on politics. The supplier for Apple and NVIDIA expects sales to grow more than the mid-20% range it had projected previously. The chipmaker also beat analyst estimates on quarterly net income. And another company lifting its outlook, it's Novartis. That forecast, though, is overshadowed by disappointing sales of the drug maker's prostate cancer drug, Pluvicto. Still, the Swiss firm sees operating income growing to mid to high teens, while keeping its overall sales forecast unchanged. And over in the UK, wages grew at the slowest pace in almost 2 years. It's the latest sign of a weakening labor market. That data is keeping alive hopes for a rate cut by the Bank of England in August. As for private sector wage growth, which the BOE watches closely, it slowed to 5.6% from 5.9%, so that is the weakest reading since 2022. Coming up, the dam finally breaks for Biden, maybe. After testing positive for COVID, the president is also fighting more calls from this time prominent Democrats to step aside. And later this hour, we're going to speak to HSBC on the market impact of the heightened expectations for Trump victory, what means the fact that he wants a weaker dollar, all of that to come on your Bloomberg Brief.
I was told that there was some medical condition that I had, and that's not the case. But I understand what people say. Look, I'm only 3 years older than Trump, okay? And I think I'm in a little better physical shape than he is.
That was President Biden in a BET interview before he tested positive for COVID on whether he would consider turning over the presidency to Kamala Harris within the next 2 years. Joining us now is Bloomberg's Chad Thomas. Chad, it's a bit awkward for the president. Granted, the White House has said that it's a mild case of COVID, but is there some degree where we look at that BET interview and we say, the president is giving himself an out because previously he said only the Lord Almighty could convince him to step down. Now he says, or not step down, but to step aside for the next election cycle. But now he's saying it could be health that allows him to step aside.
Hi, Danny. Good morning. Yeah, it does seem like he's opening a bit of a window here. And the New York Times is reporting this morning as well that he has privately been telling some Democrats that he is open to discussing this. He's clearly said that he still doesn't intend to step aside, but that he's at least willing to listen to the arguments that are being made by some top Democrats as to why he should step aside. So it does seem like there's a little bit of an opening here, and he also, of course, is dealing just with the imagery of this. As you say, the White House says it is a mild case, but now he isn't able to basically do what would have been counter-programming to the Republican convention because he is in isolation at home in Rehoboth.
I mean, it's a great point, right? He was trying to get there out on the campaign trail, which he was doing interview after interview. Now he can't do that. And the thing we're left with is Biden saying is, if I had a health issue, I'd step aside. Meanwhile, I mean, the calls and the reporting on this, Chad, it is one story after another. First, Adam Schiff speaks to the LA Times saying that he is called for Joe Biden to step aside. Then you get this news that Chuck Schumer and Hakeem Jeffries are trying to delay having him as their formally nomination process. And then you have Nancy Pelosi speaking to Biden. Again, all of this, different reports from Times, from CNN, some of our own reporting. Is this finally, Chad, the dam breaking?
Well, Danny, it does seem like it's headed in that direction. As you say, there are all sorts of U.S. media reports, including reporting we've done ourselves, that President Biden is being told privately by a number of top Democrats, all those individuals that you mentioned, that he may have to step aside. They are not only concerned about losing the presidency, but also what it might mean for Democrats in both the House and Senate if he were to lose. And there are some media reports that he is also being shown, President Biden is being shown private polling that shows he is falling behind in these key swing states, Pennsylvania, Michigan, and Wisconsin. And as you know, those are key to any chances of him winning the presidency once again.
Yeah, I mean, again, I think just the sheer number of leaks themselves even tell us something. The fact that it is a fractured Democratic Party that's willing to go to the Times, to the Journal, to CNN, and discuss these things. And then the counter-programming of that, Chad, is the RNC, where you have people who were once never-Trumpers, were once his rivals in the primaries coming and speaking, of course, the chief of which being Senator J.D. Vance, who officially accepted the GOP nomination for vice president. Here's what he had to say in his speech at the RNC.
We need a leader who fights for the people who built this country. We need a leader who's not in the pocket of big business, but answers to the working man, union and non-union alike. A leader who won't sell out to multinational corporations, but will stand up for American companies and American industry.
I mean, really laying out a very specific version of the Republican Party. Chad, what were your takeaways from that?
Well, it's really, in many ways, Danny, about the imagery, right? It couldn't be more striking. You have the Democrats fighting with one another, both publicly and privately, and then you have this real unity being shown at the Republican convention, and J.D. Vance at the forefront of that. And here you have someone who is working class, someone who is young, out there speaking on Trump's behalf.
Chad, thank you so much. That is Bloomberg's Chad Thomas. We'll catch up with you again in a little bit. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger. Let's go through the front page news, what's making headlines around the world, maybe aside from U.S. politics. First up, Chinese President Xi Jinping has mapped out his long-term vision for the nation's economy after a key meeting wraps up. They will push ahead with its pursuit of high-quality development. The plenum was the first meeting focused on reform since 2013. Okay, elsewhere on the FT, Warner Bros. Is weighing a possible split to boost its flagging stock. They discussed splitting its digital streaming and studio business from its legacy TV networks like CNN and HBO. The CEO there is also examining several strategies as he navigates the company's $39 billion debt load. And this is the best one. The Wall Street Journal has this. Ken Griffin now owns an 150-million-year-old Stegosaurus, because why not? The billionaire purchased it at Sotheby's for $45 million. That's the most ever paid for a fossil at Sotheby's. Now, he's not going to even keep the thing. He's going to lend, quote, Apex to a museum in the U.S. Now, he does have a history of trophy purchases. He outbid crypto investors in 2021, for example, for a first edition copy of the U.S. Constitution. Incredible. Okay, coming up, we are going to be speaking with HSBC on the heightened expectations for Trump victory, what it means for these markets, on your Bloomberg Brief. From our global headquarters in New York, I'm Danny Berger. Bannis Cranny is off this week. Let's set your agenda. Mounting pressure, President Biden faces even more calls to step aside as the White House says the former president has tested positive for COVID. Countdown to the ECB, the central bank is expected to keep rates steady with policymakers waiting for more data. And TSMC boosts its forecast in a show of AI confidence after the chip sector takes a beating from political risk. We bounce back from that this morning but it was a tough day. It was the worst day for semiconductor stocks since COVID times of March of 2020. It is that rotation that has been in full force that takes a breather today. S&P 500 futures up by 0.25%. It is Russell 2000 futures, which fall 0.1%. But hey, after 5 days of gains of something like 11%, maybe it is a rally that is due for a breather and some profit taking. Tech outperforms this morning after strong TSMC earnings. Is that enough to push through the political noise? NASDAQ futures up 0.5%. Meanwhile, your 10-year yield up nearly 3 basis points. 4.18% is where we stand. A 20-year auction that was plenty strong yesterday, showing that there is appetite to buy duration despite political concerns. Now, on that point, President Biden, he is currently in isolation after contracting COVID. Take a listen to his interview before he tested positive on whether he would pass the torch to Vice President Kamala Harris if his health declines.
Only if I was told that there was some medical condition that I had. And that's not the case. So, but I understand what people say. Look, I'm only 3 years older than Trump, okay? And I think I'm in a little better physical shape than he is.
Let's get back now to Bloomberg's Chad Thomas. Chad, I actually want to pick up on where we left off. The idea, not necessarily of Biden's COVID timing, but of the leaks coming from the Democratic Party. It is a drip feed of either people publicly saying they believe Biden should step aside or privately, perhaps the most high profile of which being Nancy Pelosi. What does that tell us about the state of the Democratic Party right now?
Hi, Danny. Well, it tells us that top Democrats want Biden to step aside. This isn't accidental that these leaks are coming out across all sorts of U.S. media, including to us, that top Democrats are privately telling him that he can't win. There is some reporting in U.S. media as well that top Democrats have told him, look, we're telling you this privately now, but if you don't step aside, we're going to go public in the coming days. So there surely is a lot of pressure here being exerted by top Democrats. They're concerned not only about potentially losing the White House to former President Trump, but also what it might mean down ticket for people who are running in tight electoral districts, whether for Senate or for Congress.
Yeah, I mean, there was this belief that after the events over the weekend, the quite shocking events, we should say, of the attempted assassination of Donald Trump, that it gave Biden some breathing room, that it took focus away from him, and thus he continues to be top of the ticket because there is chaos elsewhere and you need a steady hand. That hasn't been the case. And Chad, what I find really interesting about this is the polling discussion, that people come to Biden, Nancy Pelosi, one of them, saying, look at the polls. We can't win with you at the top. And Biden says, well, for every poll you have that says I can't win, I have one that says that I can. I mean, how are people trying to frame this at the moment, Chad?
Yeah, the polling discussion is very interesting, and you have private polling that the Democrats are doing that shows, not only that Biden is losing when you look at the sort of from a national point of view, but in very specific swing states, he is falling further behind Wisconsin, Michigan, Pennsylvania, states that he needs to win, and he's even now very close with former President Trump in Virginia, a state that he won by 10 percentage points the last time around. There's also a public poll that was out yesterday that showed 2/3 of Democrats want him to suspend his campaign and allow someone else to run. Surely top Democrats, when they go to him, are pointing to that to show that the support of his party just isn't there.
Chad, talk to us about the split screen America has right now of, on one hand, those leaks and calls from the Democratic Party, and on the other hand, the RNC right now.
Yeah, it couldn't be more different. You have this real unity that you're seeing within the Republican Party. Many people who were anti-Trump before, people who ran against him in the primaries, now lining up to say that they support him. People like Nikki Haley, and of course, at the top of that is J.D. Vance, who is now his vice presidential candidate. He was speaking last night in front of everyone at the Republican National Convention, and of course carried live on primetime across TV as well. And he's projecting exactly what Trump wants, this idea of a working class individual, someone who's younger, someone who backs his populism. He's certainly not someone brought onto the ticket to draw in voters in the center, but really someone who's going to fire up the base, the Republican base, and get them to the polls come November.
Chad, we really appreciate your reporting all morning. That is Bloomberg's Chad Thomas. Now, HSBC's Daragh Maher weighs in on the impact of the current political landscape, writing, "We concede there is momentum in dollar selling, which has seen it mostly ignore potentially positive factors like strong U.S. retail sales, Fed rhetoric, rising U.S. yields, alongside polls showing heightened expectations for a Trump victory." Daragh joins us now. He is the head of FX strategy at HSBC. Daragh, thank you so much for joining. I mean, there are so many political threads to pick apart, but let's just start with this idea that, I guess, the jawboning from Trump, from J.D. Vance, did lead to some dollar selling. How enduring is that?
I think we'll have the law of diminishing returns there. You know, we had this during the first Trump presidency. He talked about the strong dollar's killing us. You remember all of that? And, you know, it did have an impact. But as it was repeated, of course, it has a diminishing impact. We've heard it before. You get that with central bank rhetoric as well. I think what we had this week was perhaps a more exaggerated response in the currency market. Because, oh, wow, it's been a while since we heard that. And he obviously still holds that view. So I think there was a revelation there. But I think for it to be repeated and carried on, I'm not sure that we get that same kind of punchy impact in the currency market.
Is there an issue, though? You look at a day like yesterday, where it wasn't just the FX market, it was this more general risk-off, whereas equities sell off, bonds kind of don't do much. But dollar in most of this year, in scenarios like that of this market, has been, well, the dollar's a haven. The U.S. economy is so much stronger. Just throwing a political element into it mean that the dollar's qualities as a haven aren't as strong?
I guess it becomes more complicated. I mean, one of the curiosities at the moment, as you describe accurately, that the dollar over time is a safe haven. And typically that's reflected in an inverse correlation with equities. When equities goes up, dollar goes down. Over the last month, the dollar correlation with the S&P 500 is a big fat zero. So it's like it doesn't care. And you know, sorry to diminish, because I know we all want to talk about politics, but I also think the dollar doesn't particularly care about politics. People say, what does, you know, this rising probability for Donald Trump to win the overall presidential election? We've had that, let's say, for 3 months, where it's been accelerating. Dollar was down in May, up in June, and down so far in July. So what does that tell you? I think it tells you the dollar is looking elsewhere. And so we have to speculate, we have to talk about it, but in reality, I think we'll always come back to what does it mean for the Fed.
I want to get to that, but I just have one more question on the politics. Sorry to do this to you, Daragh. I just want to get on this idea, again, that Trump and J.D. Vance both want a weaker dollar. Both of them are talking about devaluing the dollar. And I know you very well put it in your research that tariffs, that sort of policy leads to a stronger dollar. So let's say they were like, Daragh, we want to bring you on to consult for us. What can we do to weaken the dollar? What could they actually do?
Well, look, it's tricky. And look, I want a Lamborghini. It doesn't mean I'm going to get one, right? So let's be honest. You can see the appeal of a weaker dollar, particularly for, you know, a narrative of we need to boost American manufacturing, we need to be competitive, you know, others are, if you like, using their weaker currencies to gain an advantage. That's what we heard in the first administration under Trump. If we get a second, we're likely to hear it again. But it's hard to deliver because, you know, the U.S. economy is powering along. GDP now, according to the Atlanta Fed, 2.5%. The rest of the world is kind of struggling. China is under-delivering. Europe barely coming out of recession. The UK is actually, I guess, doing a little bit better. But you still feel there is this US exceptionalism story. It draws in capital. You got nice carry in favor of the dollar. So sure, they may want a weaker dollar, but the fundamentals at the moment still support and keeping a strong dollar.
Okay, well, let's talk about those fundamentals at this moment. Let's talk about the Fed, the thing that actually matters for the dollar. We had both Waller and Williams yesterday using language that essentially said by September we're going to be ready to cut. The market has already priced that in. At one point it was 100% probability.
Right.
But how much more juice does that trade have if this is a market that's already pricing in 3 cuts?
It's dull, isn't it?
Yeah.
Do you remember?
That's why we keep talking about politics.
I mean, I'm much older than you, but I at least remember a time where you could come to a Fed meeting and not know what they were going to do, right? Now it's like you're handheld months, weeks at least in advance. So, yeah, September feels like that's where they're guiding us all towards the first rate cut in September, fine. I guess where the challenge becomes is the market wants to think, not only are we going to get a second cut this half, they want to flirt to the idea that we get third. Now, allowing for the fact that July's a non-event, that means successive rate cuts, or else it means they start by doing 50. And I think both those scenarios require you to have a much more sinister view on the US economy. You need initial jobless claims to be firing higher. You need the labor market to be falling off a cliff. We're just not seeing that. So, I think we get one rate cut, maybe we get two, but the idea that, hey, two's nailed in and we should really be thinking about a third seems a stretch to me that I think makes the dollar at these levels, a reasonably good option to buy.
I wonder if some of the dollar strength also comes from this idea that at least verbally saying, look, we're going to start cutting, allows other central banks to start cutting. And that, in turn, again, just comes back to the dollar and strengthens it.
Look, I'm glad you mentioned relatives, because that's what it is about. And I think maybe it's in America that we kind of lose sight of that, but that we're very Fed fixated. Okay, so the ECB aren't going to do anything today, whatever. But, they've already started cutting. The Bank of England will at some point start cutting, other central banks. So we are very Fed-centric, and the currency market is very Fed-centric. And I think that misses a part of the equation, which is they're not going to be the only ones doing this. And, so you think you're absolutely right. I think that opens the door to currency weakness elsewhere. And remember, too, that these other economies that are struggling, like Trump, like Vance, they might quite like weaker currencies there as well. So they're not necessarily going to be at least the dollar remaining stable.
Mark McCormick to me yesterday put it that currency traders are serial monogamous and they can only think about one thing at a time. So maybe that's also the issue. They can only think about the Fed. Though the one central bank that would absolutely welcome that, a weakening in the dollar, would be the Bank of Japan. And we saw that yesterday, the yen falling in a big way. I just wonder what you make of a day like that, where it's based on politics, not necessarily something changing in Japan.
It shows you where positioning is at, though, doesn't it? So we had we assume the big intervention last week, and that prompted a big move lower in dollar yen. And you would have thought, okay, we've cleared out the weak longs in dollar yen. And yet yesterday, when you had that news, you had those comments, and well done to Business Week and Bloomberg for getting that, that were market moving. But the exaggerated price action in yen, I think, reflected positioning and reflected, as I said at the top, that this felt new again. Even though we'd heard it before, it felt new for this election cycle. So I think that's why it's such a big impact. But yeah, the MOF will be sitting back going, thank goodness. And the BOJ will be thinking about their meeting, at the end of the month going, okay, that might just reduce the pressure for us to hike rates.
Yeah, and again, it's this irony that the MOF job owning and intervention doesn't do a lot, but it's Trump that does something for them.
Job owning, though.
Yeah, for sure. Hey, Daragh, it was so wonderful to catch up with you. Thanks for coming in early for us. That is Daragh Maher of HSBC. Okay, coming up, we're going to talk about TSMC flexing its pricing power, a show of confidence in the AI boom. Shares up nearly 2% in the pre-market for its U.S. listed shares. It's your Bloomberg Brief. I'm Danny Berger. A quick check on TSMC shares listed in the U.S. getting a boost. Pre-market up nearly 2%. The chipmaker lifted its full-year revenue outlook. Tom McKenzie joins us for more. Tom, this, of course, comes after a day when TSMC was punished, as was the entirety of the chip sector, on politics. What does this show us about the balance of this market of earnings, fundamentals versus the politics coming through?
Yeah, there's a tension there, certainly, between the demand for AI and then the politics that continues, of course, to evolve, and more negatively, as you've said. And we'll get into the details of that and the implications for this company longer term. But the near term, the most recent quarter, you've seen a 36% increase in profits for TSMC, which, of course, churns out those AI chips, the GPUs for the likes of NVIDIA and Apple, of course. It's looking at margins, Danny, of 53%. The CEO saying, when our clients and customers do well, we do well. And that is certainly articulated and underscored by that target around margins. They're also narrowing their focus in terms of CapEx. Really important for analysts because that talks to the demand that they see going forward. They've actually raised it to the higher end of their range, their previous range, to between 30 and 32 billion US dollars. This is a company that sees continued demand then for those AI chips. They continue to build out to try and meet that demand. The CEO saying that the gap in terms of supply versus demand is still wide and takes them into 2025. The other side of this, for TSMC is that the smartphone market is also starting to turn around. So on the two sides, the AI chips and then smartphones that had been in a slump, that is starting to come through for them, and they are continuing to build around the demand needed for AI. Really interesting, for the first time in their earnings, the demand for AI, revenues from AI, I should say, came in above 50%, making up the majority of their revenues, more than half of their revenues for the first time for TSMC. But you're absolutely right, the political headwinds are also there.
Let's talk about those. Okay, TSMC falls 8% in the U.S. session yesterday after Business Week's interview with former President Trump, where he more or less says, we're not going to come to the rescue of Taiwan, or we maybe won't, because they have the entirety of the chip business. Again, the fundamentals for TSMC, Tom, as you were just laying out, are so strong. So what about the long term then, if there is this new geopolitical risk that we have to factor into the company?
And you saw that, as you say, because of the risk that a Trump administration, if that's what we see in January of next year, doesn't take that line around protecting Taiwan, then clearly the foundries of TSMC are at risk if Beijing pushes ahead with their idea to bring Taiwan back into the fold. TSMC are planning around this for the longer term. They're building out foundries in Japan. They're building out and investing in foundries in Europe. They're trying to mitigate some of those contingencies, but that will remain a risk. And from the other side of the political spectrum, of course, the Bloomberg reporting that the Biden administration is looking to severely increase the restrictions of the supply of tech into the chip sector of China. And that came through yesterday as well. So those two factors, both from Trump and Biden, coming to the fore in terms of the geopolitical risks for the semiconductor sector. Then you have Goldman Sachs saying, look, some of these mega cap tech names, maybe they're overspending on AI. But again, I'll take you to that gap that remains between the supply and demand. Barclays saying that gap is likely to expand not just to 2025, but to 2026.
Tom, thank you so much for that. That is Bloomberg's Tom McKenzie. Okay, let's stick with earnings, because we had, on one hand, good TSMC earnings. United Airlines was a different story. Its current quarter's profit was below Wall Street estimates. They expect ticket price pressure to last through mid-August. Let's bring in Bloomberg's Sid Phillip on this. Sid, it's something similar to what we heard from Delta. And I think it came to a shock as a lot of people, because this was supposed to be the time that, sure, consumers weren't spending on goods as much because of those price sensitivities, but they were still spending on fun. So why? Why is there this dampened demand for summer travel?
Yeah, so for the airline industry, it is a massive sort of drain, because summer travel is basically when they make most of their money. And for carriers like United and Delta, they were expected to be sort of raking it in during the summer season, and that isn't happening. That airlines talking about how that's being impacted by overcapacity in the general market from the low-cost carriers, and that's really sort of had a dampener on summer, the outlook for summer, and also sort of yield pressure, and that's sort of adding to their pressures as they go into the sort of slower months.
And of course, it's not just United, it's not just Delta. Lufthansa also recently had their earnings where they warned about the same exact thing. So what does it mean in terms of capacity, for example? Because they're all talking about that they have more seats than can be filled. Should we, for example, be expecting for some of that capacity to come offline and for us to have to spend more on ticket prices?
Yeah, so at the moment, I think the airline industry is has clamored about capacity and said the fact that they haven't been able to get new planes. But the fact remains is that the ramp up from COVID has been sort of rapid, and that's sort of has been rapid in terms of both fare growth as well as capacity growth. And I think we're sort of reaching a peak of normalization in the industry, and I think that's where the airlines are sort of struggling, because costs have also gone up, and if they're not able to sort of keep growing revenues, that might sort of be a deterrent to like profitability, and that's why the airline industry is sort of at the moment sort of looking for ways to try and get around the sort of overcapacity in the system. But there will be some overcapacity, as lots of airlines have lots of planes that they're trying to fly and competing for the same passengers.
Yep, fair enough. Sid, thank you so much. Bloomberg Sid Phillips there. Okay, a quick check on this bond market, because you do continue to see this push and pull between flatteners and steepeners. That steepener trade has long been seen as one that is a President Trump trade. In other words, you are selling off bonds, but you're doing more so on the long end because you're scared of the deficit and scared of duration, and that needs to be priced in. However, yesterday, it was flatteners with a very successful 20-year auction. Shows that there is still demand for duration. Today, we resume with the steepeners. But again, this trade just keeps getting slapped in the face with a push and pull between the economics, between supply, and between the politics. Okay, coming up, we are going to set you up for your day ahead. Another busy day, more in politics, more from the RNC. We'll lay that all out for you to come on your brief. This is Bloomberg Brief. I'm Danny Berger in New York. Okay, let's set you up for this trading day on your Thursday. The ECB rate decision, that's the main one. It comes at 8:15 a.m. Eastern. We're expecting no change. The important thing will be President Lagarde's news conference that will follow shortly thereafter, whether she signals any cuts to come this year. Then we're going to have Netflix. They will report its second quarter results after the market closed, the first of the big tech names to do so. Most of them start next week. Plus, former President Trump, he will be giving a speech at the RNC tonight as he officially accepts the nomination as a Republican presidential candidate. Yesterday, it was J.D. Vance continuing a lot of that same language, the very populist type of language, hard on China, hard on Wall Street, and talking to the middle class. Okay, let's get a quick check on your equity market this morning, because the rotation, at least for now, has stopped. It has been a forceful rotation that yesterday was underscored not by outperformance of Russell 2000, but underperformance of the big cap tech names, of Nvidia, of the chip stocks, having their worst day since March 2020. Maybe today helps with strong TSMC earnings. Can the fundamentals come back and be the thing that saves this market over the anxiety of politics? This earnings season is going to be crucial for that. Okay, that's it for your brief. Surveillance, that's up ahead next.